Hey everyone, welcome back to Actual Investing. Today we're going to talk about a company called MSCI, which just reported earnings and is down something like 8.5% at the time of recording pre-market this morning. So let's talk a little bit about what MSCI does and whether I think the stock is a buy right now after the earnings drop. So this is from MSCI's website. Essentially, MSCI is an index provider for the finance industry. So I do have a finance background, so I'm quite familiar with MSCI. Essentially, what they do is they research global markets and put together benchmarks that fund providers can use to build mutual funds, ETFs, other types of financial products off of. So let's say you want to build let's sum one of these here, momentum ETF. So you want to track stocks that have strong momentum. So that means that their price has been rising, and supposedly if you're a momentum investor, you think the price is going to continue to rise, right? It has momentum. An object in motion tends to stay in motion kind of thing. So what MSCI will do is go out and find all of the stocks that have momentum and put together an index, and then they will license this data to a provider such as, let's say, Vanguard, and Vanguard will use this index and build an ETF around it. So MSCI does all the work. Vanguard gets paid their advisory fee, right, for the assets under management that they have, and MSCI makes a tidy profit. So it's a very lucrative business model. I really do like MSCI's business model, and it's a business that has very low cost of revenue and very high gross margins. So that is what has caused MSCI to be so profitable recently. So you may be wondering why the stock is down this morning. It stems mostly from higher cancel rates. So this is their earnings release. They did have revenues of $680 million, which is very strong. And it is up about 15% year over year, so 14.8% year over year. However, it fell short of Wall Street's estimates. Wall Street was hoping that they would grow a little bit more rapidly. This is a deceleration in revenue growth. Last quarter, they saw something like 19% year over year revenue growth. So from 19 to 15, that is a pretty significant drop in just one quarter. So we see that their CEO said that elevated cancels reflected a concentration of unusual client events, including a large merger among our banking clients. We're managing through these pressures and do not expect this level of cancels to continue. Okay, so what I'm hearing is that this is a temporary issue that's caused by a merger, right? So that means that two of their clients are now one of their clients and are cutting their costs. Okay, that's reasonable. So let's look into why MSCI may be a good investment and their valuation. So they do give full year guidance, but they don't give revenue guidance, interestingly. The only reason why that might be okay is that MSCI isn't necessarily a growth stock, and it's also not necessarily a value stock. It's kind of a bit of both. So it does have double-digit revenue growth, but it also has strong profitability, and it pays a dividend that grows every year. So quick tangent, MSCI has been growing their dividend for 10 years now. So in 2014, they paid a dividend of 18 cents per share. They grew that every single year until 2024, where each quarter it's $1.60 per share. So that's almost a 10x in their dividend over 10 years. So it is a dividend growth company as well as a revenue growth company. We see that, yes, it also comes with a relatively high PE ratio because they still have that revenue growth. So typically, if you have a very slowly growing company or a company with no growth, their PE is going to be a bit lower. But if you have a company that's growing revenues year over year, their PE is going to be higher. Think about like a Tesla or a NextEra Energy. Well, Tesla isn't growing so much right now, but historically has had high growth and a high PE. Anyway, all that is to say is that MSCI doesn't provide revenue guidance because they're not necessarily a growth company. It looks like they're more focused on their cash flow. So they're expecting net cash provided by operating activities to be around $1.35 billion for 2024. So when we compare that to previous years, we can see that last year they had net income of 1.15. So that would be a steady increase in net income. We can see that this is a very profitable company. On last year, on revenues of $2.5 billion, they made net income, so this is profits, of $1.2 billion. That's amazing. That's almost a 50% operating margin. That is just wild to think that this company can be that profitable. Okay, so now the bad news. MSCI has a lot of debt. So if you know me, you know that one of the things I like to look for is a strong balance sheet. So here we see the opposite. We see that the yellow liabilities bar is a bit higher than the blue assets bar. And if we look at cash, they have 500 million in cash, but they do have debt of 6 billion, over 6 billion. Yikes. So here's why MSCI doesn't think that's a problem. Here on their investor presentation, they actually think that they have a strong balance sheet, which is funny. They don't. I mean, it's not like they're going to go bankrupt, but I would not call this a strong balance sheet. So what they're saying is that their debt that they have doesn't mature until 2029 at the earliest. Okay, so that explains where they're coming from. So it's 2024, so they have 5 years until they have to pay off this debt. Okay, that's great. That gives them 5 years of profits that they can stash away, rebuild that cash position, and pay off the debt when it comes due. So they seem to think that they will not have an issue paying off that debt, and I would tend to agree because this is such a profitable business. Oh my gosh, if they made 1.2 billion in profits last year, let's just say that that doesn't grow. So in 5 years, that is 6 billion in profits. That is more than enough to pay off all their debt, not just the debt that comes due in 2029. So, okay, so I think I can look past the poor balance sheet based on this knowledge, knowing that their debt is not going to come due until 2029 and that they do have these amazing profits. So this debt comes from acquisitions. Typically, when a company acquires a smaller company, they pay in cash or shares. And with MSCI, if they don't have cash, they will take out a loan, a debt financing in order to acquire a smaller company. So in order to grow, MSCI has been a serial acquirer, and that is why they have so much debt on their balance sheet. We can see that they do have credit ratings, which essentially says how likely this company is to pay back their debt. And their credit ratings are fair. So BBB is what I would consider the bottom of what you would want to look for. However, it's still acceptable. So the credit rating agencies, which is Moody's, S&P, and Fitch, all seem to be somewhat confident that MSCI can pay back their debt. Okay, so that's the debt conversation. I think I can look past that. Let's go to my spreadsheet and see how MSCI ranks on my spreadsheet. So this is a sheet where I rank on 4 factors. These are gross margins, annualized revenues, valuation, which I measure by price to annualized sales, and growth. So those 4 things, I think, make a strong company on a very surface level. If you have high gross margins, you can compete on costs with your competitors. If you have large annualized revenues, it means you've captured a large portion of your market. If you have a low valuation, it means I'm not paying as much for those revenues. And if you have high revenue growth, it means that your valuation is going down, all things held equal, every year. So that's why I use my 4 factors. This is just a very cursory look, but we can see that, like I said, MSCI is very profitable with gross margins of 82%. When we look at their operating expenses, SG&A, which is selling, general, and administrative, that's things like staffing and advertising. And when we look at R&D, which is research and development, we see that both of these together are only 27% of their gross margins. So that means that 73% of their gross margins goes right to the bottom line. Well, not right to the bottom line, but is not used on their operating expenses. So that's great. We see a very, very profitable business, raised their dividend for 10 years in a row. We should assume that that's going to continue. And they have, like I said, double-digit quarterly year-over-year revenue growth. It is slowing down, and I think that's why the market is punishing MSCI today, because the bad news, MSCI has a steep valuation. So not all revenues are created equal. So when you have a very profitable company, they tend to have a higher valuation because most of those sales are going straight to profit. So we see that MSCI has a valuation of 15 times price to annualized sales. But, however, this does not incorporate the drop that we saw this morning. Today's drop may change this to something like 13 or 14. That puts it somewhat in line. I can actually see I have all my averages for this spreadsheet. My average price to annualized sales for my spreadsheet is 10, so that does put MSCI above average. So even though on the surface everything else looks great, their valuation is steep. Would I buy MSCI? That is the question of the day. My thought process is I am not looking to purchase MSCI shares today because I already own a company called S&P Global. S&P Global operates in a similar field as MSCI, where they provide benchmarking. So S&P Global, of course, known for the S&P 500, which is one of the largest indexes in the world. So to me, I don't necessarily need two index providers with MSCI and S&P Global. I think you could make the case to hold both, but I don't necessarily need that overlap. I already have a good chunk of different diversified stocks in my portfolio. I don't see the need to double up. However, if I didn't own S&P Global, I might be interested in getting into MSCI today because I do think the drop is a bit exaggerated. Let's go to Morningstar really quick. This is an investment research website that I tend to trust, and I usually look here to see what other people think of the stock. Morningstar puts MSCI's fair value at 480, and it's actually just below that this morning if the drop holds. So it seems if Morningstar doesn't change their fair value based on this earnings report, that Morningstar seems to think that MSCI is a bit undervalued. Okay, I think that I would tend to agree. I think that if you're a long-term investor and you want to get exposure to a growing dividend and growing revenues, MSCI is a great place to look. I think if they ever need to, they can cut down on acquisitions, pay off their debt, become a bit more of a stable company, and just focus on growing that dividend. So if you're a value investor, you could probably find a lot to like about MSCI. But if you're a growth investor, I think it might also be appealing. So those are my initial thoughts on MSCI. If you have any questions about the company, want to know more about what they do, please leave them below. If you want to know what I think about a different company, please also leave that below. I have a list going of subscriber suggestions. I believe my next is going to be Symbotic. But yeah, please let me know if there's a company you'd like me to cover. And in the meantime, thanks so much for watching. And please like the video and please subscribe if you have not already. And I hope you have an awesome day.